to the Money RX for CRNA's podcast, where you go behind the scenes with host Brett Fellows, CFP, as he explores the unique opportunities and challenges facing certified registered nurse anesthetists along the path to financial independence. In each episode, Brett shares expert insights and actionable advice, equipping you with the tools you need to take control of your financial destiny and retire on your terms. And now, here's your host, Brett Fellows.
Welcome to the Money RX podcast for CRNAs. As I record this, CPAs around the country are in a mad frenzy to complete as many tax returns as possible by April 15th. CPA spouses and parents will be missed daily as they grind out long hours of tedious tax return intricacies. Now, I know this for a fact because I'm married to a CPA. So, as we all find ourselves in tax return season, I thought it would be helpful to use this episode to review a tax return from 30,000 feet in hopes to help you better understand yours. I can't tell you how much time we spend with clients reviewing their tax returns together. I would say that more than 90% of our new clients tell us they don't even understand how to read a tax return. Oddly enough, second to understanding tax returns, clients tell us that they really don't understand their insurance policies, what they cover, which ones they need, and why they need it. So for today's episode, I want to talk about these two really important areas of financial planning that usually get talked about last, or frankly, not at all. And that is understanding your tax return and insurance policies. Now, if these two subjects are so important, why don't we like talking about them? Well, I think as human beings, we like to feel that we have freedom to choose and make our own decisions. Yet when we feel forced to do or pay for something, we take extreme displeasure in it. And sometimes it feels like the act of paying insurance premiums or taxes is not a choice we have, but rather something we must do. So let's learn about these two subjects and see if we can't change our mindset, get you more confidence and clarity around the how and the why you're paying taxes and insurance premiums. Okay, let's do a quick overview of your tax return. Now, taxes are inevitable, but there are some methods you can deploy to lower your overall tax burden. So I want to use this episode to dig into the basics of tax planning and offer a few tax tips. And keep in mind, entire books have been written about tax planning, so today we're just hitting the highlights. So our tax return tells a story. You may look at it and think it's wildly confusing, upsetting, and anxiety-provoking, but I invite you to look at it with curiosity. There are a few really important numbers in there. First and foremost, your total income earned is on line 1. Now, there are various lines for income earned through investments, income from a business, adjustments to income, and then your adjusted gross income, or AGI. The IRS taxes you based on your adjusted gross income less any deductions. And trust me, everyone likes to focus on deductions. What deductions can I take to pay less in taxes? Well, some common deductions are mortgage interest, property tax, business expenses if you have business income, medical expenses above a certain threshold, and charitable contributions. But for most, the standard deduction, which is $14,600 in 2024, is high enough that they will not itemize. To itemize your deductions, you need to find more than $14,600 of deductible expenses if you're a single filer, or $29,200 if you file jointly. As of this recording, the highest tax rate is 37% for taxpayers. The tax rate is on a scale. Those who earn less pay a lower percentage of their income. The lowest rate is 10%. Now, a common misconception that I run into a lot is that you pay taxes at the rate of whatever tax bracket your income falls into. This is not the case. You pay more tax on each additional dollar that you earn above each threshold. Therefore, if you're a single filer with $150,000 in AGI, you would fall into the 24% tax bracket. But you will not pay 24% on all your earnings. You will pay 24% only on the additional income earned above $95,375, which is the top of the 22% tax bracket threshold. If you're in the 24% tax bracket, you owe $16,290 plus 24% of any amount over $95,375 and under $182,100, which is the 24% tax bracket from lowest to highest. So although you fall into the 24% tax bracket, your effective tax rate is only 19.6%. That would be $29,400 in tax divided by $150,000 in AGI. For you CRNAs who are business owners, self-employed, and freelancers, you often have tax considerations and challenges that are quite different from those individuals with just W-2 income. If you fall into this category, we won't get into it today, but we'll have a podcast episode coming up just for you on this topic, so stay tuned. Now, many companies today offer qualified traditional retirement plans such as 401ks and 403bs. And since contributions to these traditional retirement plans are made with pre-tax dollars and returns accumulate tax deferred, any individuals who participate in these plans stand to benefit on their tax bill, especially those in higher tax brackets. The money placed into these traditional accounts needs to remain in them until you reach age 59 and a half, at which point they can be withdrawn without any penalty. The penalty for withdrawing early is 10% plus any taxes owed on the withdrawal. Money in a traditional qualified retirement plan is not taxed until the funds are withdrawn, which often occurs after the retiree has left the workforce, is earning less, and is subject to lower tax rates. Retirees are required to begin withdrawing money at a certain age, and as of 2024, the age for these required minimum distributions, or RMDs, is age 73. The contribution limits for qualified retirement plans is $23,000 for 2024. And that number increases by $7,500 for those 50 or older. And this amount is called a catch-up contribution limit because it's designed for those who have not yet accumulated enough in retirement savings. Now, if you do not have a qualified retirement plan through your employer, then you are probably eligible for an individual retirement account, an IRA. CRNA taxpayers can deduct contributions to a traditional IRA from their taxable income. For 2024, individuals can make contributions and thereby take deductions of up to $7,000 or $8,000 if they're 50 or older to traditional IRAs, not Roth IRAs. The money can generate returns over the years, and the penalty-free withdrawals can begin at age 59 and a half. And like qualified retirement plans, RMDs for IRAs begin at age 73. Now, if an individual or couple has retirement plans through work, then IRA contribution amounts might not be deductible or may only be partially deductible. So be sure to work with your tax preparer to make sure you're eligible. Capital gains and dividends are treated differently than income. When you go to work and earn income, you are taxed on a different schedule than if you take gains on your investments or receive dividend income. And to make matters more confusing, some investments pay ordinary income through interest or ordinary dividends, which is taxed the same as the money you earn at work or your ordinary income, without being subject to payroll taxes. The dividends that receive more preferential tax treatment are known as what's called qualified dividends. Moreover, short-term gains, which are profits from the sale of an asset held for less than 1 year, are also taxed as ordinary income, while long-term gains, the profits from a sale of an asset held longer than a year, are taxed on the same schedule as qualified dividends. Capital gains and qualified dividends get special treatment. They are taxed at 0%, 15%, or 20%, depending on your taxable income and filing status. We'll definitely spend some more time in future episodes digging into taxes and tax savings tips, but I wanted to give you this quick overview, if you will, so when you look at your tax return in the next few weeks, you have a better understanding of how it flows from a high level. Almost as confusing as tax returns seem, we have insurance policies. So let's switch gears and talk about those. Insurance is a tool to protect yourself and your family in a world of uncertainty with hidden risks. Different types of insurance are all around you, from policies covering individuals who get sick to those covering homes against floods and earthquakes. But the point of insurance is to cover losses that you would not otherwise be able to afford. So when considering insurance, you must think, what is the risk and can I self-insure? Insurance is a contract. In exchange for premiums, the insurance company will pay for whatever is in the contract. If you buy a 20-year term life policy and die in year 19, well, they will pay out the value of the contract. Conversely, if you die in year 21, they will not. If you stop paying premiums, the contract will cease. Now, your takeaway from today should be that we don't know what the future holds for us. Therefore, the number one rule, again, when choosing insurance is to cover catastrophic losses and let the little stuff go. What are the most valuable assets in your life? Well, how about your income? Unless you're living on your assets, your income is the most important thing you have to build wealth and afford future flexibility. If you are the primary earner in your family, then you may need life insurance and disability insurance. If you're an independent CRNA, then you may need to protect your business against lawsuits. How about your health? There's health insurance, and there's also long-term care insurance. Your large purchases. Unless you have a huge amount of savings, you'll want to cover catastrophic losses related to your home or car through property and casualty insurance. To repeat, the fundamental inquiry that should govern all of your insurance decisions: what is the risk and can I self-insure? So if I could give you an action item that you can apply now, I would say make a list of your most valuable assets. If something happened to any one of them, could you cover the loss? How about, does anyone depend on you financially? If something were to happen to you, would you want their financial needs taken care of after your death? Well, I recommend life insurance to those with children, anyone with a business, anyone with a taxable estate, and those who want to leave a legacy. Now, determining how much life insurance you need takes a little math. You want to begin by assessing your liabilities and your assets. The greater your liabilities, the more life insurance you will need. Generally, as your assets grow, your need for life insurance will decline. So you will not need life insurance forever. You will only need it until you have accumulated sufficient assets to self-insure. Most life insurance policies fall into one of two categories: term and permanent. Term life insurance is the simplest kind because it offers death protection and nothing else. It is more affordable than other policies, especially if you are young and in good health. The typical term life policy is in effect for a specific length of time, thus the name, which can be as short as 5 years or as many as 30 or even longer. A term life insurance policy usually has a fixed premium that remains the same throughout the life of the policy. Permanent life insurance has both a death benefit protection and a cash value component. Now, the cash value is a type of savings vehicle that can be used to obtain future loans, withdraw cash, or pay policy premiums. These policies require fixed premiums, which a portion covers the insurance, and the rest is deposited into a separate cash value account, which earns a rate of return. Permanent policies are typically more expensive than term because of the cash value account. In addition to that, permanent life differs from term insurance in that it exists until the policyholder passes away or stops paying the premiums. There is no fixed term. I'm going to be honest and say that for most, I prefer term life insurance. My main issue with permanent insurance is that they are often used as a forced savings account. But if you can easily save money, you don't need a permanent policy to save for you. You will do better with a diversified asset allocation that matches your needs and risk tolerance. However, if you have trouble saving and decide to purchase a permanent life policy to help you, you'll be very likely to let your policy lapse when income runs out, and then you will lose all coverage. If you have cash flow problems, this is not a solution for you. Instead, work on your cash flow issues to create savings. Now, I am a husband and a father. I want to make sure that if I die, my family is protected. So I bought both a 20-year and 30-year term policy. Now, this is known as laddering life insurance. The 20-year policy is there to cover short to medium-term needs if something were to happen to me. I have the longer 30-year policy to cover our mortgage and because I don't want to apply for more insurance later in life. But for many people, a 20-year policy is long enough because the children should be grown and financially independent by then. But laddering is a great tactic. It provides more coverage in earlier years and less coverage in later years. You pay higher premiums in the initial years when savings are lower, and then pay lower premiums in later years when you can mostly self-insure. Now, to calculate the right amount of life insurance really depends on your situation. For our purposes today, I'm going to give you two hypothetical examples using a 20 times income ratio. So first example, let's say a couple in their late 20s. He makes $75,000 per year and she makes $60,000 per year. They have 2 children. So what are their insurance needs? Well, let's start with the husband. His income is $75,000. If we multiply that by 20, we get $1.5 million. So very easily, that is his insurance need. Now, to ladder the insurance, I would recommend $1 million 20-year policy term with a 530-year policy term. And for the wife, her need is $65,000 income times 20, which is $1.3 million. And similarly, I would get her a $1 million 20-year term with a $300,000 30-year term. Now, let's look at a single mom in her 40s with 2 kids. She makes $70,000 per year. Her insurance needs are this. Again, take the income, $70,000 times 20, $1.4 million. But I would recommend she only needs a 15-year policy because if she dies, she will have no retirement needs and she doesn't have to leave anything for her spouse and her kids will be all grown. So a 15-year policy is all she needs. So knowing the right combination of life insurance coverage is a matter of personal preference, risk tolerance, and current savings levels. But having life insurance should help you sleep better at night knowing your family is financially protected. It should not be an added source of stress. My recommendation is to envision the results you want for your family in case of your untimely demise. Once you do that, you will know what you need when you take the time to think about it. Now, in today's age, you are much more likely to become disabled than you are to die. And modern medicine has made it possible to save many lives. You know this. But what would happen to you if a disability occurred? The outcomes are highly dependent on what you do for a living. For example, I can do my job as long as my brain works. Were I to break both of my legs, yes, it might be difficult for me to get new clients since I would be less mobile. However, I would be able to maintain my current client load. Not every profession is like that. If you are a CRNA, you need your hands. If you fell and broke your hands while skiing and can no longer work, then your income would significantly decrease. Therefore, your profession is the most important thing to consider when you decide on disability insurance. Disability policies can be purchased for short or long terms. Now, short-term plans typically only pays benefits up to 2 years. A long-term policy will usually pay until age 65, and you can collect Social Security from that point after. Sometimes employers offer these benefits at very reasonable rates, and you use pre-tax income to pay a portion of the disability premium through payroll. Since both you and your employer are using pre-tax dollars to purchase the contract, you will pay taxes on any benefits you receive through your policy. However, if you purchase a private disability policy, you will pay with after-tax dollars and receive benefits tax-free. Policies often cover about 60% of your income. Therefore, with a private policy, your after-tax benefits will likely look similar to your after-tax income pre-disability. I like to think of home and auto insurance as typically forced expenses. You can't get a mortgage or a car loan without them, and we purchase them because we can't afford the consequences. So for this reason, I like high deductibles on home and auto insurance. It reduces the premium, allowing you to save more for a day when you need a landing pad. If you have a good emergency savings fund, a high deductible will be no problem for you. But if you do not, then you will need to pay higher premiums in order to cover a little fender bender or a small house issue. As usual, savings gives you more freedom and flexibility. I think similarly about health insurance. When you are young and healthy, it's good to have lower premiums and higher deductibles. Unless your company is completely covering your health insurance cost, this will save you a ton of money. In addition, high deductible plans often come with a health savings account, or HSA. Now, HSAs are tax advantage medical savings accounts. And after you turn age 65, your HSA becomes a retirement account that you can use to pay any expenses, not just medical ones. While I do not specialize in health, auto, or home insurance planning, the topic of umbrella insurance often comes up in my practice. It can cover many events that are not covered or provide coverage beyond what your existing home or auto policies will. So in short, umbrella policy is designed so that you never have to live a nightmare. Maybe your dog gets loose and bites your neighbor in the butt, and you get sued. An umbrella policy can help pay the legal and/or medical bills. The coverage from umbrella policies can be expensive. So the best time to shop for coverage is typically when your income or net worth reaches a certain level. Generally, I recommend shopping for plans when you are making more than $100,000 a year or have $1 million in assets. I also suggest getting at least the amount of insurance that you have in assets. That way, in the rare event that you're sued, you have the insurance to cover the legal bills without dipping into your savings. So I hope you can see from today's episode that as fun and talking about investing or making money can be, it's worth nothing if we don't protect from our life's three largest altering factors: death, disability, and taxes. So hopefully you have at least some insurance and you regularly pay your taxes. If you haven't done so with either, then I challenge you to address these right away, because it's much easier to imagine your financial success once you've started your awareness of cash flow, whatever direction that might be. And trust me, over time, you'll find that you learn what's working and what's not, and you can refine your cash flow to get better and even provide more financial success for yourself in the future. But now is an important time for you, and I don't want you to keep pushing things back and not addressing your money. And yes, I know life gets busy and in the way of things, and things happen, but I want you to get started because the fear about addressing your money problems is a good sign. So I hope you found today's episode helpful as you think about your upcoming tax return and where you are today with insuring your greatest assets. And given that everyone is different and everyone has unique needs and circumstances when it comes to tax and insurance planning, it's nearly impossible for me to cover everything in a podcast episode. So if you have any unanswered questions about your insurance planning or your tax return, or maybe you just need a recommendation or a resource, please don't hesitate to reach out. And actually, this is even better. I am willing to offer a free tax return analysis for our listeners. The only legwork you would have to do is send us a copy of your tax return. We'll, of course, arrange so you can send that securely, and I'll put a sample copy of one of our free tax return analyses in the show notes for you to look at. If you find that you're interested in this free tax return analysis, you can shoot me a note. My direct email is brett@oakcapitaladvisor.com, or directly schedule time with me by going to our website, oakcapitaladvisor.com, and click the free pre-op assessment link where you can schedule a call and meet with me at your convenience. Take a minute, too, to give this show a review on iTunes or wherever you listen to your podcast. We would really appreciate that. And that would make it easier for other CRNAs to find us when they're searching for podcasts. Thank you for listening to this episode of Money RX for CRNAs, and have a great week.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.